Hey, good afternoon, everybody, and thanks for joining. Welcome to our DCR Partners webinar on the minimum viable company. The first part, what it is and why it matters, and importantly, perhaps it's going to be a bit of a conversation rather than slide after slide after slide. Okay. Quick bit of housekeeping before we start. So the session will run for 60 minutes. We've saved the last 15 minutes for your questions. So please, on the way through, put them in the chat as they occur to you. All right. And Ryan is going to be the quiz master at the end. And we will work through your questions in the last 15 minutes. So 2 quick introductions before we get started. So Brian Hercombe, I'm a director in DCR Partners responsible for resilience and cyber. I've spent around 30 years in the cyber resilience crisis and enterprise risk space, and most recently spent most of my time with boards, helping them understand what happens when severe disruption crosses from service failure to institutional viability. Joining me today is my colleague, Ryan Taylor. Ryan leads a lot of our delivery work with clients on operational resilience, enterprise resilience and MVC, and has been inside a number of firms helping them build this practically. Ryan.
Thanks, Brian. I'm Ryan Taylor, manager at DCR Partners. My background, as Brian mentioned, is in operational resilience, crisis management, and severe but plausible scenario work. I've really spent the last few years working with UK financial services firms and other regulated organisations on how their resilience plans actually hold up when tested in real disruption. And that's the lens I'll try and bring today.
Thanks, Ryan. So today we're going to talk about a gap that we think exists in how the industry is thinking about resilience. And I think importantly up front to say it's not to dismiss anything that's been built. Much of it is real and much of it is valuable. But what we want to do is name a layer that sits underneath it that we think, and our experience is telling us, that most institutions haven't really looked at properly. We're going to work through why that layer matters, what it actually contains, and what we mean when we talk about the oft overused term of minimum viable company. And then in future sessions, we'll get into how to actually build it. And in session 3, we're planning to hear from some of our clients, some of them who've lived through it and had to build their MVC at pace under extreme duress. Right, so let's crack on. Really pleased you're here. This might sound like a really obvious place to start, but we're going to come back to this time and time again throughout this. The observation really is that for all organizations, the mission hasn't changed. It hasn't changed since time immemorial, really. Every institution has a mission and it has 3 parts. Really, really simple. Part 1 is delivering the things that matter to the customer. So why did the customer come to you in the first place? If it was delivering pencils, part 1 of your mission is to deliver pencils. All right. Part 2 is around maintaining the operation that delivers the business, so the machinery of the business. And part 3, and you're going to hear a lot about this throughout, is to remain viable as an institution and be still on the pitch when things don't go well. Those 3 parts side by side in peacetime. So deliver for the customer, maintain the operation, and remain viable as an institution, remain on the pitch. Those 3 things in peacetime all run in parallel. They have different owners, but they're of equal value across the organization. So the mission hasn't changed. What has changed is the environment. We used to talk about disruption as an episodic event. In fact, we built our entire response around that idea, dealing with one thing at one time in one place. But actually, events are moving faster than our decision cycles and our plans were ever built for. Disruption is now permanent. It's not episodic. It is our new operating condition. So systems, third parties, data, people, regulators, all sit inside a tightly coupled web. And there are 3 things going on in the environment. macro factors. So we've got geopolitical instability, energy volatility, supply chain weaponization, climate shocks. All of this background noise has actually now become foreground pressure. And in the threat environment, these macro factors are amplifying the environment. Cyber's moving at machine speed, state-level activity, concentration in critical providers, and attacks that are now escalating from incident to institution in hours, not days, and not weeks. And then the third part, enterprise fragility, tighter supply chains, concentrated tech estates, strict operational redundancy, and deeper third-party dependency. So organizations have less slack to absorb the shocks. The threats are getting worse, and the enterprise is becoming more fragile, and the gap between them is widening. Brian, you're already seeing what that gap looks like when it's crossed.
Yeah, absolutely. And, just to give some examples, we've seen in the last few years how this has played out, right? You think about energy shocks from 2022 onwards. We had Ukraine, the Middle East, where we are today. These were the macro events that have transmitted directly into the cost base and solvency of many firms that had done nothing wrong operationally. They'd had no system failure, they'd had no process breakdown. They basically just had an environment that changed rapidly underneath them. Another example is COVID, something that changed every organization's operating environment overnight. They built for an operating model and for an environment that no longer existed, and no sector was exempt. And again, more recently, and you'll recognize the next example, is a major UK manufacturer. They had 5 weeks of total production halt from a single cyber event, cascading hundreds of suppliers into trouble and costing the UK economy a huge amount of money. They were 3 different causes: macro, human, and cyber. But there was one clear pattern. Every one of those organizations had BR plans, BC plans, crisis teams, but the disruption still escalated into organizational viability questions that they hadn't yet answered. So what we're going to do throughout the next hour is give an example, a fictional example of how this all plays out, right? So meet DCR Manufacturing, right? They're a mid-sized UK manufacturer. They make products at a single site, sell to businesses and customers. There are a few hundred people and turnover in the tens of millions. The mission is the same 3 parts that Brian just described, right? They deliver products to customers, maintain the factory and the operation around it, and remain a viable trading business. And the environment has changed for DCR Manufacturing too. Energy shocks hit its cost base. COVID shut down the factory for months. Supply chain events stopped components arriving on time. A cyber event took down the ordering system. And last July, a routine software update from a trusted security provider crashed half of the systems in the building. That wasn't an attack, it was a patch from a supplier they were paying to protect them. That was all in the last few years, the same environment everyone in this room is operating in. So this isn't going away, Brian.
No, it definitely is not. Look, I think it's important to recognise the work that's been done in the industry. We've talked about BCP, we've talked about DR, we've talked about BIA, cyber third party, all of that work. None of it's new, and most of it's been in place for a decade or more. But for a long time, those things sat in silos. We're still dealing with clients today whose BCPs reflect their organizational structure, not their ability to deliver services. With, frankly, each discipline protect its own patch. It's effective when it's within its own remit, but they're not talking together. And it's not very often we thank the regulator, right? But OpsRes has changed that. So OpsRes was the first discipline to force proper cross-silo thinking. It changed the question. So it's not, do our components work? It's, can we deliver the service? All right. And to answer that, we had to map the services end to end. And what we found, of course, is those resources, capabilities, and services are across the entire organization. So from our perspective, that was a genuine step forward. And I think it's fair to say that most folks in this virtual room will have done that work. important business services. And if you're not financial services, don't worry about the terminology. Service is just the same. Tolerances and severe but plausible scenario. Years of work, serious investment, and producing something real. So I think it's important to recognise that when we talk about MVC, none of this is about throwing the baby out with the bathwater at all. Everything that you have done to date and all of the work that has been created and the culture you built in your organisation all plays a part in delivering the minimum viable company. All right. So, Ryan, what did the ops rate shift really give firms?
Well, it gave quite a lot, actually. You've already mentioned a few parts there, but it gave firms a view of service delivery they generally didn't have before. Right, for the first time, you could see a service end to end. You've already mentioned the technology, processes, third party, people. All in one place. I think as well that it forced a parallel functions to start talking. BCP, DR, cyber, third party risk, all having to look at the same service together rather than protecting their own patch. It made third party dependencies visible in a way that hadn't been before, and you could actually see that whole chain. I think most importantly, it gave the board for the first time a credible answer on whether specific customer services could be sustained under disruption. Impact tolerances, severe but plausible scenarios. Those are now standard board level language. So again, as you referenced, that work was real. It was valuable. It took years and it took serious investments, and that's certainly not been wasted. The question it didn't answer was fundamentally organisational viability in severe, prolonged disruption, and prolonged is probably the key word there.
Yeah, and I think perhaps picking up on the words prolonged, I think when we talk about crisis, I think we instinctively think, what, a couple of weeks?
Yeah.
And if we put things in place, what, we can undo them in 2 weeks, right? We'll be okay.
Yeah.
I think to give you the right frame of reference, think 4 months in to that manufacturer who may or may not make cars with no end in sight and under a continued duress, right? So when we talk about timeframes, that's the kind of time frame we're talking about. These are not temporary fixes. All right, this is about establishing your baseline in a way that is sustainable for a considerable period of time. All right, so let's come back to the mission and the 3 parts. So let's run through it again. Deliver customer outcomes. If you make pencils, keep making pencils. Maintain the operation. Well, what's the operation to make pencils? But importantly, the third part, remain viable. So the work you've done today, operational resilience, absolutely covers deliver customer outcomes, right? If we think about it from a regulated perspective, you deliver your customer outcomes through the delivery of your IBSs, right? And maintain the operation, that's a part that sits underneath that makes it all work, all right? So operational resilience absolutely has a space. But strangely, the part that we don't talk about a lot is remaining viable. What does that mean, and how do we address it? I'd said before that these 3 parts all have equal weighting when in peacetime on a day-to-day basis, right? We put equal effort into delivering customer outcomes, maintaining the operation, and remaining viable. But in times of extreme duress, the ability of the organisation to remain viable is the precursor for its ability to maintain the operation and deliver outcomes. Okay, fundamentally, if your organisation is no longer a going concern, you have no ability to deliver customer outcomes or indeed maintain your operation. So this is a space we're going to focus on today, the remaining viable space. And this is where the MVC exists. So what we're going to do is talk about viability. You'll see the parts on there. There's 6 of them. I'm going to talk through the first 3, and Ryan's going to talk through the other 3. But essentially, when you look at any organisation, and I mean any organisation, pencil makers, soft drinks manufacturers, banks, building sites, it doesn't matter. There are 6 dimensions to viability. Okay, so really, really obvious. Start right at the beginning. All right, the legal right to exist. Right. Authorization and legal standing that allows the institute to operate. All businesses have to abide by certain laws, depending on sector, to maintain a legal right to exist, right? I'll give you an example of where that was removed. So Uber, London, 2017, 2019. TfL twice refused to renew the operating license. Okay, so the company existed, it had money, it's got users, it had the technology, but it didn't have the right to operate. Okay. Moving on to financial viability. What is it? This one's really straightforward, right? Solvent, liquid, able to fund itself in normal terms. Where are we seeing that go wrong? So Carillion, January 18, UK's second largest construction and services company, 7 billion in liabilities, 29 million in cash, and 43,000 jobs affected. So winning government contracts week before the collapse, right? It was solvent on paper, but actually insolvent in reality. And then the third one, operational capability. We talked a bit about this. The ability to sustain the core operations when it comes to viability, access to the right data systems and third parties. All right. So the UK manufacturer that Ryan described earlier, 5 weeks of production halt, cascading impact across hundreds of suppliers, and 1.9 billion in economic losses. They were authorized solvent, they just couldn't operate. Ryan, take us through the next three.
Yeah, cool. Thanks, Brian. So number 4, governance and control. You know, what is this? Well, this is essentially the ability of leadership to make decisions, maintain oversight, and act lawfully. Think of Boeing in 2018, you know, 2 737 MAX crashes. They had 347 people killed. What emerged from that was systemic governance failure. You know, in safety escalation to FAA certification, and how in effect information moved from engineers to the people making decisions. You know, the aircraft was grounded for, I think it was 20 months, tens of billions in costs, and successive CEOs forced out. You know, again, to Brian's point, Boeing was authorized, it was solvent, it was operational, its governance was hollowed out. Right? If we think about number 5, stakeholder confidence, well, this is whether customers, counterparties, markets, and regulators still believe in the organization enough to keep dealing with it. Do they still trust it? If you think back to Northern Rock, I think I was 13 actually at the time, so I probably don't remember it. But you know, it's a really good example. This was the first British run on the bank in 150 years. You know, there were queues, and you've all seen them in the news and on the newspaper, queues around the block. Deposits being pulled out despite Bank of England support, and they were nationalised within months. And confidence here was the catalyst. And again, if you think number 6, regulatory obligations, well, what is this? It's the organisation's ability to continue meeting what the regulator requires. You know, reporting, capital, conduct, etc. Now, an example here is Volkswagen in 2015. I'm sure you're all aware of the emissions testing software scandal. It was installed on 11 million vehicles worldwide. There was over 30 billion euros in fines, settlements, and buybacks. The CEO resigned within days, and criminal prosecutions followed. You know, and in severe cases, this can take you back to condition 1, right? To loop the legal right to exist. So now, these 6 on a list. They're in effect a system. A failure in one can cascade across the others. And we've all seen this play out, right? So lose your license and counterparties leave. Lose counterparty trust and liquidity evaporates. Lose liquidity and governance starts breaking down under pressure. And importantly, you know, these failures can unfold at different speeds. Weeks for some, years for others. But the pattern remains the same. You know, in peacetime, all 6 are held through normal governance, annual reporting, capital planning, board oversight. All of that existing machinery works. However, under severe and importantly prolonged disruption, all 6 can come under pressure simultaneously. And that's where the industry is probably prepared the least. You know, we've got no thresholds, no pre-agreed decisions, no integrated view that pulls the 6 together under pressure. So Brian, I think we're moving on to identity.
Yeah, we are, but I think perhaps just the viability point, we'll talk about a little bit later about, I think, bank in a box, etc. All of these have a place. I think our point really here is to say, in terms of where do you begin and why begin here? You know, what I hope you can see is there's a baseline of things here that we need to understand. We need to be able to define metrics around them. And importantly, your board needs to make decisions around those things. What are important, what are less important. And what you'll find when you break down those viability dimensions is you will find a number of them that are mandatory. And we'll talk about levels here in a moment, without which you are no longer a going concern. And a number of them which are slightly less mandatory. I think anybody who's worked in a regulatory space will understand the difference between the two. So this is all about understanding the absolute minimum, the mandatory stuff that must be done before we begin. Okay. Now, the part that goes hand in hand with this is identity, which feels a little bit like a bit of an abstract concept, but a serious question. And we spend time with marketing teams, PR teams talking about exactly this. Who does the organization want to be under duress? Now, not 2 weeks duress, 4 months duress with no end in sight. And how would they like to be seen by the regulator, their own staff, their stakeholders, the public? All right. So what we do is we spend time working through those viability dimensions on the left-hand side. And then we couple those with a set of identity positions, and we ask 3 key questions. So who are you for? All right. And what that gives us then is a pre-agreed stakeholder hierarchy. You know, so when we can't serve anymore, we've already decided who we serve first. All right. The point here is these should not be decisions made at 3 o'clock in the morning by a gold commander. All right. And then we move on to what we're responsible for. Right. So this gives us a pre-agreed accountability boundary. So when things go wrong, we have already decided ahead of time what we own and what we will not disown. And then the final point, how do you want to be seen? Right. So what is our pre-agreed stakeholder facing position? Now, trying to get your head around some of this can be pretty challenging. Talking to marketing teams and say, well, we've got our pre-can comms and our crisis management plan. And we say, well, okay, sure, great. That's a fantastic place to begin. But when your viability is challenged and you're 4 months in and can't see a way out, what's the conversation then? And what we find is organizations who've thought that through ahead of time, all right, tend to do much, much better. All right. And the final point, what will our stakeholders see us doing, right? What will they hear us saying? And what will they observe us prioritizing? A really interesting example is the values of an organization, right? Your values in your organization were written on a sunny day on a Wednesday afternoon, the sun is shining, kids are playing in the park. And we write these wonderful values. We're now 4 months into an existential crisis with no end in sight. How many of those values are still true? Now, some organizations say all of them. Some say, actually, not all of them. These ones are important to us, not these ones. Okay, so right at the top of the shop, when we think about MVC, minimum viable company, the clue is in the title. All right, the first thing we think about are the 6 viability dimensions and how they apply to the organization. And for those of you who haven't met every team in your organization, do this and you're about to. All right, 26 different teams in an organization, give or take, to get the answer. All right, and what you'll come up with there is a set of obligations that sit underneath each one. And you'll be able to work through them and understand what must you do, what should you do, what could you do, okay? But in concert with an identity position. And bringing those together into a single view essentially gives you your top line view of your minimum viable company before you begin. Now, we talked about, we're saying the what and the why. This is some of the what, but the why here. What we see a lot of in the market in the moment, driven by tech vendors, is it's a tech solution. Mm-hmm. Or it's a supercharged obsolescence solution. Or we spring forward into MVC I think what we're saying is you would lean back into it. You know, it is the absolute basis of your organization. And if we don't understand these pieces, all right, what you'll find as you work through this, and we'll work through some of it today, you'll see that the rest of it starts to come adrift and doesn't quite fit together.
Thanks, Brian. So I think it's probably worth going back to our example, right? Let's go back to DCR manufacturing. Yeah. So what they built over the last decade, well, they've built everything that you'd already be familiar with: business continuity plans for the factory, DR for IT, cyber protections, supplier contracts with alternates, and more recently, you know, the service mapping that comes with broader resilience thinking. You know, and that work is real, and most of the time it holds. But now apply those 6 conditions. So DCR manufacturing can lose its operating licenses, you know, through environmental or health and safety issues. It can run out of cash. Carillion did this with a full order book. It can lose operational capability from a factory fire, cyber event, a key supplier failure, etc., etc. Governance could fail. Customer investor confidence could collapse, and regulatory breaches could threaten its ability to trade. Now, apply identity to that. Who is DCR manufacturing for when it can only fulfill a third of its orders? What is it responsible for when product defect emerges? And how does it want to be seen when it's struggling publicly? You know, none of these are addressed by the plans that DCR manufacturing has today. And when severe disruption lands, those are the questions that ultimately matter most. And those are the questions that your gold team will be having to work through at 3 o'clock in the morning on a Saturday evening. And it's the ones that they're probably least prepared for today.
Thanks. So let's move on to actually talking about the minimum viable company itself. All right. So you'll hear this a lot, so I'm perhaps just going to describe it up front so we're clear. For the regulated folks among you, this will make sense. For the not, I hope this will make sense too. In an organization that delivers services, so regulated, IBSs, paid, other companies have essentially built the same structure, right, but used different names. All right. We think about those services as the most important thing that we deliver, priority one. You know, and the way we think about those is priority one is those key services, then priority 2, you know, is the services that enable those, 3 is criticality, etc., all the way down. Okay. When we discuss minimum viable company, we're talking about priority 0. Okay, we're putting it ahead. Because back to the original point about the mission, viability is the precursor to deliver customer outcomes and maintain the operation. All right. So we're going to have a look at the 6 dimensions and 3 identity positions, and just work through priority 1 versus priority 0 and what that means. Right. So inside both the 6 dimensions and the 3 identity positions, not everything is a viability killer. Right. Some obligations can flex, some cannot. And in essence, your level 1 obligations are your day-to-day obligations. Regulated folks deliver IBSs. That's a regulated level 1 obligation, right?
Yeah.
All right. And we then look at those and we break those down and say, actually, what sits in there that must be delivered no matter what? I'll give you an example. So we take financial viability. Inside that single condition, right, you've got things that can absolutely flex under pressure, right? Dividends can be suspended. Bonus pools deferred, growth capex can be paused, all right? But inside that same dimension of financial viability, there are things that can't flex. Payroll for the core operational team. You would be surprised how many companies forget payroll in this conversation, right? The energy bill that keeps your factory lights on, and mail at trade. Senior debt covenants that if breach trigger insolvency overnight. All right, so we have a dimension, financial viability, but within that, as you pull it apart, what you'll find is level 1 day-to-day obligations. All right, but within those, what you'll find is some level 0 obligations that must not ever be breached, beyond which bad things happen, essentially. So same condition, 2 layers inside of it. And that pattern repeats across all 6 of the conditions. Okay, so we have to split priority 1 and priority 0. So most organizations understand priority 1. All right, this is the day-to-day stuff, service delivery, operational continuity, full peacetime obligations. Priority 0 or level 0 obligations sit underneath that. And those are the irreducible minimum that must always hold, even under complete duress. Okay. So the floor is level 0. These are the obligations that form the basis of your minimum viable company. Okay. So let me, oh, sorry, Ryan, thoughts?
Yeah, so I think, is it worth just giving a quick example? You know, let's say, you know, you take both dimensions, right? The 6 conditions and the 3 identity positions. You know, they're pre-decided in peacetime. They carry into the moment as operational reference points in effect. On the 6 condition side, the organization has already worked out what is irreducible. You know, what irreducible minimum actually looks like for them. You know, not aspiration, actual specifics, what it can accept losing and what it cannot. On the identity side, the organization has already answered those 3 questions. You know, who are we for? What are we responsible for? And how do we want to be seen? You know, written down and approved and testable. You know, put those 2 dimensions together, and what you in effect produce is a set of survival objectives. Yeah, concrete statements of what the organization must still be doing, still responsible for, and still be recognizable as at level 0. You know, and again, not aspirations, not principles, but clear, defined objectives. And I think when you get to that level, that's the sort of thing that a board can commit to because it's definitive. You know, a management team can act on defined objectives, and a regulator can also look at it and test it and understand it. You know, those survival objectives are what the organization then measures itself against. You know, they are what the thresholds sit under, and they are what trigger those pre-agreed decisions. You know, how survival objectives actually get defined is the work of session 2. We're going to go into the how in a couple of weeks. Today, the point is that they exist and they sit at the heart of MVC. And ultimately and importantly, and I'm going to labour this point, none of it is decided under pressure. All of it is decided in peacetime and executed under pressure.
100% correct. I mean, the MVC is what you pre-decided, right? Holding on to what you didn't.
Yeah.
All of this work, most of this work actually, can be done ahead of time and worked through. There's a lot of decisions in here that you do not want somebody making under pressure in the middle of the night. Do I focus on financial viability? Now, what do I do about governance control? And what humans tend to do in those situations under pressure is default to what they know. You know. So anyway, let's go back to the mission. So come back to the 3 powers. So as I said, in peacetime, all 3 powers run in parallel and equally supported. Under severe duress, though, institutional viability, so remain viable, the right-hand side, becomes a precondition for the other 2. So the other 2 may fail, the 3rd can't. And as I said, you can't deliver services if you have no institution left to deliver them. And that's what your MVC defines. That's what it means to design the institute or the institution to operate through disruption and not avoid it. Right, back to your DCR manufacturing. We need another name for that, I think.
We do. It's an awful name, right? So what's the MVC actually look like, right? Let's take DCR manufacturing as an example, right? Priority 0, their floor across both dimensions. Well, they've got 6 conditions, right? Their operating licenses are retained. Minimum cash to meet payroll and essential suppliers. They've got minimum production capability intact, even if it's at a fraction of normal output. Board and accountable managers are in place, and key customers are informed and willing to stay, and the regulator is engaged. They don't have a full factory. The absolute minimum to remain viable, licensed, operating has been maintained. So if we look at the 3 identity positions, they've all been pre-decided. Who will we for? Well, the customers who have already ordered and are waiting, period. Not new customers, not growth markets, not prospective deals, existing customers with unfulfilled orders. What we're responsible for, well, honouring those orders to an extent that we can, and being honest about what we cannot. And how do we want to be seen? Well, competent, honest. We've maintained our integrity. We're still here. We're not pretending that everything is fine, and we're not disappearing in silence. Right. So that's MVC in effect for DCR manufacturing. It's not a reduced factory. It's an alive business. Everything else can come back later. But ultimately, that absolute irreducible minimum can't be lost.
Thanks, Ryan. So why don't we move on to what the MVC looks like, and we'll give you a top-level view of the reference architecture. So just a word on language that I think is important, because you'll hear this described in various ways. And by the way, none of them are wrong. Everything is valuable and it all fits together really nicely. And this architecture helps it do that. But you'll have heard minimum viable bank, minimum viable service, bank in a box, obtuse on steroids, as I said, right? That's not what this is, but they do fit. Most of those frameworks are about delivering reduced services under pressure. So if priority 1 are your main services, that would kind of be priority 1 minus. What we are describing, the clues in the title, right? It sits below that, the minimum viable company operating on level 0 architecture. So Ryan, why don't you run us through the top level view?
Yeah, cool, of course. So if we just take it from the bottom, actually, right? So to deliver anything, right, an organization needs resources, and there are in effect 7 of them. There's, and those of you in the room with an op-res background, you'll be familiar with those minus the logistics piece, and that'll become clear later. But there are people, process, technology, data, third parties, facilities, and logistics. Those are the building blocks. Capabilities are collections of resources arranged to do something specific, right? And the services are capabilities connected to deliver outcomes. And services deliver the obligations the organization exists to meet. So that's four layers in effect. You've got your resources, capabilities, services, and obligations. Every organization has this architecture today running at level 1. For those in regulated financial services, that's in effect your IBSs. And every firm that I've worked with or been part of can map themselves against those 4 layers. Now, those other frameworks you may have heard of, bank in the box, minimum viable bank, they sit inside specific layers of this stack. Bank in the box is technology configuration, right? It still has its place. It lives under resources, 1 resource out of 7, in effect. Now, minimum viable bank is a services question. Without services, which services do we maintain at reduced capacity? Again, valuable work, but pieces of the picture, not the full picture. So if we go back to sort of level 1 and level 0 architecture, Brian, how would you best articulate that?
I think perhaps starting with MVC is not a new architecture.
Yeah.
I think that's the key thing. We're not building something new. It's your own architecture. If you think about prioritizing your architecture, and I hope what you can see is all the way from an obligation, defining it as a survival objective, more on that to come. There's quite a few areas to work through on that. Down at the conditions that we must meet, and then the capabilities and resources that deliver them. What we're doing is looking at our own architecture, right? Saying, how do we deliver that today? And is that resilient enough as it is? The answer, by the way, is probably no. So where we end up with is you're able to define your level 0 architecture that sits inside your own enterprise. It's already there. And then the question becomes, how do we build resilience into that, and how do we protect it appropriately? Okay, and then we move back to level 1, right? How do we deliver our IBSs, level 2, et cetera, et cetera. So it's the same stack, same machinery. It's just redirected against a different purpose and protected appropriately. Okay, that's what makes MVC buildable. It sits on top of what you already have. MVC is your own architecture, redefined at level 0 and protected appropriately. I think one of the things that might be worth talking about just for a sec is MVC and operational resilience. They are absolutely complementary. We've talked through how the thinking is basically the same, right? We're just applying a different lens. But once the institution holds level 0 through disruption, it's still alive. And by the way, when we still alive, we mean breathing, but probably not much more. Okay. As conditions change, as the environment becomes more permissive, it can start recovering. And recovery then is a transition from level 0 back to level 1. Conditions return to full service. Survival objectives relax back into full peacetime obligation. Same capabilities, same resources, different top layers. That recovery journey is absolutely operational resilience territory. So operational resilience tells you how to bring the services back in the right order against the right priorities with intolerance. But operational resilience recovery has to start from something. That something is MVC. And without MVC, there's not a starting point to recover from fully, because arguably the institution may not be alive to do the recovery. So MVC is the floor you recover from, and operational resilience is how you recover back. And we need both of those to work together.
I think as well, Brian, another thing to mention is if you think about within the context of the type of scenarios we're talking about, prolonged 4 months in, no end in sight, you've likely already breached impact tolerance on multiple of your IBSs. Right, so we are beyond the point of impact. And again, I'm sorry, I'm talking to financial services terminology here, but you're beyond the point where you've probably already failed in a number of those IBSs. This is about absolute viability. MVC is the floor. Operational resilience, once you start to recover, is the mechanism to allow you to recover. Awesome. Shall we go back to DCR manufacturing?
Do.
Right.
I'm keen to hear.
So let's make this a little bit real. DCR manufacturing at level 0 is not a new business. Brian's already mentioned that. It's the same business with its own architecture, identified and protected on the floor. They've got the same resources. The minimum production and safety staff, the essential IT systems, the critical suppliers, the factory itself, the same capabilities, take an order, make a product, ship it safely. Same services delivered to existing customers, same obligations, products made to specification, delivered to those who wanted them. The stack is identical. What changes is the configuration. At level 1, you've got the full product range, full customer base, full order book. At level 0, it's reduced to the absolute minimum that keeps the business alive and the factory legally operating. From level 0, we've already discussed this, but the business can recover. That's the recovery journey that broader resilience addresses, and it starts from the floor. Without the floor, there's in effect nothing to recover to. So MVC is the floor you recover from. OpRes is how you recover back up. Shall we go into how that works in terms of thresholds?
Yeah, I'm also very conscious of time, so let's see if we can speak fast.
Yes.
So MVC, it's your own reference architecture. It's your own organization redefined as level 0, repurposed, is the first point. We've defined across 6 dimensions and 3 identity questions a set of survival objectives, which we can then break down into measurable must-do commitments, right?
Yeah.
So that floor for the institution is already pre-decided. So we understand where the floor is, and on the diagrams on the left-hand side. And we also understand what normal BAU is, right? So we have a gap. And essentially we can measure the gap and then apply proximity across them, okay? So Brian, you've lived in an environment where you measure proximity?
Yeah, so again, Brian's already sort of articulated there fairly well. Within that gap, you've got between the floor and the current state, you in effect place thresholds, right? Proximity markers on each condition. You've got 4 states, you've got normal BAU, approaching, at the floor, and breached. Each threshold has pre-agreed decisions attached. What the organisation does when it crosses that line, again, agreed in peacetime and executed under stress and pressure. What this in effect gives you is a shared reference. The board, crisis team, the regulator, leadership, they're all looking at the same data, same thresholds, same decisions, no sort of improvisation on the day. And this is the difference between an organisation that can act fast and decisively under pressure, and one that has to, again, debate every decision when disruption gets worse at 3 o'clock in the morning on a Saturday. So, this is not a new discipline. OpRes already requires monitoring proximity to tolerances for every important business services. A lot of bigger firms likely already have dashboards, board reports, escalation rhythms, and all of the stuff that's been built over the past few years. Now, MVC applies the same logic to that. It's the same discipline and viability. It's integrating reporting against the level 0 floor across those 6 conditions. And here's the thing, most of those metrics already exist within your organization. They just have to leverage them. So capital, liquidity, stakeholder sentiments, operational KPIs, etc. Every firm I've personally worked with has all of this data. Normally it goes into
all over the organization,
all over the organization. What's missing is not the defined metrics, it's just the lens that you're viewing them through, right? So this is the framing that pulls existing metrics together against the proximity to your viability floor, and the additions of the floor itself, the 3 identity positions, the thresholds, the pre-agreed decisions, those are the work, and that's how you get there.
Thanks, Ryan. And I'm going to talk quickly because I'm desperate to understand what happens with DCR manufacturing. So you've heard us say this phrase a lot, peacetime. This is all about pre-agreed decisions. A lot of them made at board level up front. Okay, because we can define all of those thresholds now ahead of time if we define the architecture correctly, so that we understand as the marker moves from normal BAU to degraded to approaching, we understand direction travel, we understand velocity across a number of viability metrics. And if we've got our integrated reporting, we're able to sell the same story on our services at the same time, okay? And we can define these ahead of time. We can be really clear what it means when you get to degraded, all right? What is the decision point? Who owns the decision? Recognizing that some of these will degrade over days and weeks, but think about a ransomware attack. Some of them will degrade in minutes and hours, okay? So what is the decision point? Who makes the decision? How quickly does it need to be made? All right. And what you're able to do is monitor your organization in relation to its own viability floor, all right, which is pretty powerful. And again, all ahead of time, because thresholds designed under pressure at 3 o'clock in the morning on a Saturday aren't thresholds, they're guesses. All right. And decisions made in the middle of disruption with incomplete information under cognitive load are the decisions that institutions regret the most. So defining floor and peacetime is the work that's going to separate institutions that come through severe disruption with reputation intact from those that don't. Final entry for DCR manufacturers.
Let's see where they end up. Right. So DCR manufacturing, all of this is measurable. and most of it is already being measured within that organization. You know, they've got cash runway, factory uptime, supplier reliability, customer concentration, safety incidents, all that sort of stuff that goes into a normal ballpark every month, right? What's in effect missing is the integrated view against that level 0 floor. So not individual metrics against operational targets, all the metrics together against the minimum the business must still be, right? Proximity to the floor. And the additions, you know, the floor itself documented, the 3 identity positions written down, the thresholds that tell the business when it's approaching and when it's at the floor, when it's breached, and the pre-agreed decisions tied to each threshold. So at 60 days of cash runway, do we do X? At loss of the largest customer, do we do Y? At factory downtime being beyond 3 weeks, we do Z, right? Again, all decided in peacetime, all executed under pressure. So that's in effect DCR manufacturing with MVC. It's the same business, the same people, the same factory, the same customers. Floor has been pre-decided, and a reference point it can measure against itself every single day.
Thanks, Ryan. So to close, Optores has built a reporting discipline for services. MVC applies the same discipline of viability. Everything you already understand in terms of process applies. And what you'll find is most of the metrics are already in your organization. It's the survival objectives that aren't, and the conditions beneath them. The floor that you can define in peacetime or discover you don't have in the middle of a disruption. One of those is a choice, and the other one is a consequence. So, and in session 2, we'll show you how we define that floor. Ryan, I think we're over to questions.
We have 6 minutes of questions. So we've got a couple of anonymous ones in the chat. By all means, if anyone on this call wants to put in another couple, that's absolutely fine. So, Brian, how would we make a start on defining our MVC?
Great question. Now, I think there's two different ways. We can say, hey, we'll do this top-down process. What we've actually found is in a single organization, there'll be 10 different versions of what an MVC is. My starter for 10 is let's arrive at a common view on what it is and what it's for. Yeah. Because there's a lot of noise in the market at the moment around this. Board thinks it's one thing. The COO says, well, we just got to get payments back up, right?
Tech will say another.
Yeah, tech said something completely different, right? So I would start with, let's decide what it is or what it is we need it to do for us. Okay.
Yeah, thank you. So we've got another one that's came in. So is your view that MVC sits below delivery of all IBSs?
I think below is probably a misdirect in terms of word. I would say that MVC level 0 is your irreducible floor. Therefore, by definition, everything would sit on top of it. What I would say though is that start with a really clean MVC, base it on the dimensions we talked about. And what you'll find over time is you end up with slightly different flavors based on the type of disruption you're dealing with.
Yeah.
But actually, perhaps based on how you approach the market. All right, so we have MVC and we have MVC plus one service. And so there's lots of different ways to configure it, but you have to start with your absolute floor and build from there.
Yeah. And the key there, not all IBSs will make up part of that floor.
Mm-hmm. No, I've got one for you. How do you think we should define, I'm assuming MVC, when we're a FTSE 100, but not a regulated PRA, FCA business? This is not a regulated piece, but I'm going to let you answer.
Yeah. So I think if we just ignore regulation for a moment,
100%.
Throw regulation out. There's no one from the regulator here, right? Let's throw regulation out the door, right? No business wants to be making those decisions, whether it's a severe cyber attack, geopolitical event, whatever shock that might cause you to start thinking about these trade-offs and decisions. No business wants to do that at 3 o'clock in the morning. Right?
Agreed.
Now, where I would start is exactly how we've articulated it. I would look at those 6 conditions. I would look at what you want to be. Now, there might be some nuances if you're a manufacturing business, or if you're an airline, or if you are a direct to consumer, whatever sort of business you are, there might be some nuances there. But the logic flows whether you are regulated or not. And the fact that you're a FTSE 100 business actually probably makes this more important, because of the impact of getting this wrong if something severe happens.
I can think of some very specific identity conditions that would apply if I'm the CEO of a FTSE 100 company.
Exactly.
Right.
And exposure.
Yeah, those 6 dimensions will apply to your organisation. I'm very conscious of time, and what I am going to commit to is we're going to share these slides anyway, but I think what we'll do also is commit to answering the questions, even just shortly in short paragraphs, so everybody gets something back.
There's one more. We've got 2 minutes, Brian, right? Any tips on how to get senior stakeholder buy-in to establish MVC when there are lots of competing priorities but no clear regulatory ask?
So I'm assuming, because you've said no clear regulatory ask, you're a regulated entity.
Yeah.
All right. I think if you look at resolvability, recoverability, ICAP and ILAP, all right, and put them all together, and then look at the direction of travel of the regulator will never ever say you must build an MVC. What they will say is we care deeply about your viability and your ability to continue to operate through disruption. I've just stolen their words. All right. So if we're waiting for the regulator to tell us, it's not going to happen. But what the regulator has said is we care deeply from a market and individual perspective as to how we continue to operate through this new disruptive world. So that would be my star for 10. But the second point is step back from this and think about the business sense in what I've just said, right? And there's lots of examples, sadly, where organizations did not. Right.
I think we are up for time, but let's commit to respond to all the questions, and we'll get back to everyone with a detailed response.
Now, there's lots to MVC, and we're going to do 3 webinars. But something else what we wanted to do is do an MVC foundation piece. And the answer to the question with the previous person was do an MVC foundations piece. We'll come see you, spend a whole day with you, Ryan and I, and help you even just get you thinking, right, what are the basic requirements, right? And how can we help you give your leadership team a clear and credible starting point? Okay, so if you're interested, scan the QR code, all right, and we look forward to hearing from you. Thanks very much and enjoy the rest of your day.
Thanks, everyone. Take care.